Hey traders, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, August 30, 2021. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. What do we have on the docket today? Well, we have a lot of stuff on the docket. It's this week, it's today, it's what happened on Friday, it's all of the above. So let's unpack some stuff. The first thing we're going to do is take a look at the daily chart. Is anything jumping off the page? Well, nothing's changed. The trend is your friend until she steals your clothes while you're in the shower. Now, let's look farther. Where are they? And what's up with that 448.90 to 450 and a quarter? Well, we're going to be able to take this off the board pretty soon. What I wanted to do is reiterate where it came from, reiterate where the market is, and also where it closed on Friday. I thought this was pretty neat. Some of you picked up on this, sent me emails and stuff. 450.25 was the closing price on Friday. I thought that there's no accidents or coincidences, therefore that was pretty neat stuff. Now, let's remember what that was. It wasn't a spot where I said once the market hits that number, it's going to turn around and go back down in the other direction. That's not what that was about. It was an area that from a very, 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 very long-term perspective, the market should be drawn up to this spot. Doesn't mean it can't stay here for a while. In my opinion, it probably won't go too much higher, but it can go higher. We're going to talk about that also in this video. And when I say shouldn't go too much higher or can't go too much higher, I'm not saying over the long term. What I'm saying is right now, as a result of the most recent recocking of the weapon. A couple of other things on the docket we can't forget. We're into the end of the month. There tends to be either real or fake what's called window dressing. I don't know if that actually goes on or not, but the market can have a tendency to go up into the end of the month and also around the beginning, like the first day of the following month. There's fund flows. It's buying begets buying. It's not really going up because of the fund flows per se, quote unquote, but mainly because other people think the market's going to go up because of the fund flows. Therefore, they buy in panic buying, don't miss the boat, FOMO, which is fear of missing out. All that stuff tends to take place. And by the way, when you're in an uptrend, any excuse to float the tape up is a valid excuse. Now, some of you might be waiting to hear a conversation around, hey, when's the next turning point in the market? And the answer is there's actually really two periods of time, but we'll compress them into one. We're going to say right around the 7th of September should be a pretty important time frame. After that, it really bleeds into the following week, where as far as I'm concerned, the market should have an appointment with volatility. Now, we know how these cycles go. The market could be making a high into this time frame. The market could be making a low into these time frames. We don't know exactly which one it's going to be, but what we can do is observe what's going on and see if the cycle date and the time frame, along with everything else that we study on the charts, makes sense for a possible turn. That's the way we approach these cycles. Before, we talked about shorter term cycles. Now, these are really pointed towards longer term cycles, which means there could be, and I use this term loosely, no pun intended, there could be some slippage involved. What does slippage mean? One side or the other, a little bit in front of it, a little bit after it, for example, slippage. It's really a way that analysts like me are able to give ourselves a little, should we say, buffer zone. I say that tongue-in-cheek. I'm expecting some activity between the 7th and the week of. So it's really the 13th, 14th, 15th. It's really middle of the month that I've got my eyes zeroed in on. Let's talk about some other stuff that's going on kind of right under our nose. So we're leading into another one of those 3-day holiday weekends. It's Labor Day. So therefore, the market will be closed on Monday, a week from today, and leading into Labor Day weekend, the volume will get lighter and lighter and lighter as the weekend approaches. We'll have some floater days, maybe a down day mixed in there just to keep everybody honest. But all in all, we shouldn't expect. Now, anything can happen, but we use the 80-20 rule. How does that work? I'll explain it in a minute. We shouldn't expect a big move in one direction or the other leading into Labor Day weekend other than a floater. So they can float the market up, and it could be a big move in the upward direction day after day after day. Are we going to get an explosive move leading into holiday weekend? I'm not exactly sure. Anything goes, but using the 80-20 rule, the large majority of time leading into Labor Day weekend, the market will kind of grind its way into a floater formation. Is there anything that could put a crimp in that? Well, there's a lot of things. There's a whole host of stuff on the wall. What wall is that? The wall of worry. We've got all kinds of stuff. We have the Fed, inflation, deflation, masterflation. Remember that from last week? We have Afghanistan. That's a debacle. We've got a swan event. There's always the possibility of a black swan, something we can't see coming. And then later in the week, we have the phony jobs number on Friday. Can they use the phony jobs number to move the market? And the answer is they can always do that. Will they use it to goose the market into the holiday weekend? Again, using the 80-20 rule under normal garden variety conditions, that's pretty much what's going to happen. What's the 80-20 rule? 80% of the time, the same stuff happens in the market, on the charts, over and over and over again. 20% of the time, something different happens. So we use it like this. If it walks like a duck and it talks like a duck, generally speaking, using the 80-20 rule, it's going to be a duck. If it's one of those other times in the 20% camp, we're going to take the mask off. It's going to be an ugly duck, and we'll be able to recognize it sooner than later. A la, if we have to lose on a trade, and this is Trade School 101, we want to lose small and fast if we have to lose at all. But when we enter a trade, we go into the trade with the concept that we're going to win 110% of the time, with the full and complete understanding that's not going to happen, but we have the confidence going in because we know our numbers, we're able to read the charts, we're able to read the tape, and we go in with the complete understanding from a realistic standpoint. They're not all going to work out, but we go in with the confidence that they're going to work out. You can't go into the market with weak hands. Why is that? Because the market is going to sniff out the weak hands. It's going to shake out the weak hands. The weak hands are, generally speaking, the last ones out before the move. You all know that. How high can this tape go? Well, from here, we don't know because we're in no man's land, but we will use the next semi-fat round number, which is really 455. So when the market approaches 455, whether it comes up short, spikes it through, we're likely to find some quote-unquote overhead resistance. Doesn't mean they can't get it to 460, 457.50, which is 45.75 when you're talking about the ES or the S&P cash index. These are all important numbers, and they become short-term targets in a trending market. That's really what's going on. The closer the market gets, the closer a price gets to some of these bigger, fatter numbers, they become magnetic and draw price in. For example, 450 is a magnetic number. It drew price in. 4.25, 500, 475, 460, 455. They're not all the same. The bigger and fatter they are, the more important they are, the more of an impact they have. But the more you go down the chain, so for example, 449 is not the same as 450. 455 is not the same as 450. 460 is not that far different from 450. It's not the same, but it's not that far off. We're just talking about the psychological impact of these numbers. Why do we bring psychology into the mix? Because the entire market is centered around mental masturbation. We all know that too. Do we have to look at the other charts, for example, the 120, the 240, and so on? The market's at new highs. What are we going to look at? For example, Here's a 120, and here's what we'll say. If they push higher, they're in no man's land. Fair enough. What if they just go sideways? Well, then they've got a bullish flaggish thing going on. What if they come down a little bit? Well, then they have the breakup candle low. So those are your scenarios. So based on what you see when you wake up in the morning or how the market trades out during the day, depending on what chart you're looking at, you have information that's important. You apply the information based on what the market is doing and what the expectation is that it should do as a result of, for example, a breakup candle low or running sideways for a long, long period of time in a bullish flaggish formation. Then the expectation would be another leg higher is coming. The risk is still to the downside to where the breakup candle low. This is the way the market works. So we can look at a 120 chart and we can have all that stuff to say, which would be similar stuff when we're looking at an hourly chart. Same story, breakup candle low, blah, blah, blah. What about inside the numbers? Anything going on in here? Not really. The market went higher right out of the gate, and then it went sideways all day long, so it didn't really do anything. That takes the opportunity away from traders. We know how that works. We're in the summer doldrums. We should expect the opportunity to be taken away from traders during the summer doldrum type markets. But the good news is, once we're finished with the summer doldrums, volatility comes back into the market. It becomes a trader's dream, and I love to use this word, it becomes a bonanza. But each and every day, we take a look at the good, the bad, and the ugly. We're going to run through the commentary, see if there was anything worthwhile for traders today, and then we'll circle back to stocks on the move, check out what happened there. So in the early thoughts, we're talking about the big fat round numbers. There's not a lot going on. They're in no man's land. I've got some stuff down south that would be interesting, but they never actually go down there, so we don't have to talk about it. So guess what? You know what happened today? They went sideways, summer doldrum tape. Therefore, what I'm going to do is scroll up, let you read the notes, go back to the chart, double check the work. But since there were light on activity in the market today, the notes are light. The day was cut short for obvious reasons, but nevertheless, we're an open book scenario. Here are the notes. We always put forth the good, the bad, and the ugly. Speaking of ugly today, we had a shitburger on our hands. We had 4 opportunities on the board today. Only one hit its price objective. Others came close and then rallied away. The one that we had, COF, hit its number and kept going down south. There wasn't exactly like that. We tried to play a little bit of maneuverability going on there, but at the end of the day, it just flat didn't work. We're going to look at the chart. Here's a 15-minute chart of COF. It was getting a buzz cut at the open. It's Capital One Financial. The numbers were the numbers, and under normal garden variety conditions, each of these spots, each of these zones would produce a reaction in the other direction. And you can see where the third one started to work out. I thought that was going to be the one, and they would rally at least back to the second one. And by the way, there were 3 on the board, but only 2 were activated. It opened below the first one, so we wiped that one off the board. So basically, the average was in here about 169.5. Later on, into the early afternoon, it closed below the stop, and that was all she wrote. It's not like we wrote it down all day long. It closed below the stop, and that was it. But I adjusted some stuff early on, before the hourly close, the first hourly close. Why was that? Because they were coming into a spot, the hour was coming to a close, they were playing games with the stop, and I wanted to see if we could get the rally. They started to rally, and then they petered out. The concept was right, it just didn't work. That's the way this business is. Obviously, there are plenty of days when this exact scenario happens. A couple of hours later, you find the thing back at 172. Not that I'm trading on hopium, but that's what I was kind of hoping for. Didn't work. Got to swallow a shitburger. Let's talk Camp IWM. So Friday, they have a huge rally. They go all the way up to that spot that we've been discussing. And what have we been discussing? What I said was that spot around 225.50 all the way up to 226.50, maybe up to 227, where this pivot high was in here comes in at 226.89. So somewhere up in that neighborhood, in between 225 and a half and that pivot high. So what's interesting was they blasted through on Friday and closed really, really well. We weren't totally surprised by this. Why is that? Because they ran a test of the lows. They got back above the important number. They recocked the weapon one more time. And they had this, what we'll call unfinished business up here at around 225 and a half. They never actually got there, and then they collapsed. So here we are. Are they going to stop there? Well, it's unlikely. They're probably going to go a little higher. We talked about that last week. But what I also said was it's unlikely that they're going to get a lot higher because of from where they're coming. So if you really look at this closer, Friday was on time day for IWM. Funny how that works. Where does that come from? It comes right out of the course, lazy E-mini trader. Today, the high happens to be 227.35. Just a little bit above that pivot high that we said. They shouldn't get a lot higher than that, at least on the first run, because of from where they're coming. Go back to the videotape. Now, oh, by the way, they close where? 225.48, 2 pennies below 225.50. That's my number that's been on the board for quite some time. It's still a bullish close. Let's call it what it is. They're now back above all the moving averages on all time frames, the daily chart, the weekly chart, and the monthly chart. As long as they stay above 225.50/226, let's say, then the door is open for 229 to 230. Doesn't mean they'll get there. Remember, Friday was on time. Today was day one after on time day. What about the folks down at the transportation department? Remember that important spot, 14,760. They had a jam session on Friday. They closed the week and the day above that spot, and we're still above that spot. Kind of sandwiched in some moving averages, but this is what's jumping off the page at me. Pretty simple stuff. I'm looking at a channel that looks like this. Now, it's not necessarily going all the way to the top and all the way to the bottom, but what I'm doing is I'm saying, what's the market really doing? If I kind of peel back a little bit and look at it from a larger picture perspective, try and get rid of the intraday and the daily noise, and I say, well, they're just eating time off the clock right around this area, around these moving averages, the important spot, 14,760. And then I would say, well, let me take a look at a weekly chart and say, well, what's important next? Now we have the weekly picture, and we see one of two things is likely happening. Either they came down from a high and they're trying to carve out a bottom, or they're making some kind of a bearish, wedgish thing. They're not really going anywhere, and they're going to have another leg down. Now, how will we know one way or the other? Pretty simple. Let's use 14,760 as a pivot. If they start getting below it, for example, on hourly closes and then daily closes, then the pressure would essentially be on the downside. The bears would really have the ball a la a bull fumble. However, if they stay above 14,760, then the door is open for 15,350. And that, my friends, is the way this works. What about the folks in Silicon Valley? What's going on with Q people? The trend is your friend until it's not. Bullish with a twist of bullishness. This could be in the midst of, and it could really span across other markets, and it can happen pretty quickly, one of these melt-up operations. Now, we've been in the scenario before where they kind of set the stage or set the table for one of these melt-up operations, and they never really did it. Melt-up operation, blow off top, S&P, or let's just use SPY, goes up, let's just say, between 5 and 10 points in a day or two, and then all of a sudden, out of nowhere, just reverses. That's the type of thing that could happen. We're in that setup scenario. The ingredients are there. We don't know it will happen, but we have to be on the lookout for the melt up slash blow off scenario. Not just applied to the Q market, but applied to the SPY, the Dow, across the board. It would basically be a rising tide lift all boats. It's all the same market scenario. Just when you thought it was safe to get back in the water, you flip over to the financials and you find out, they had an outside day after making a nominal new high. Is that material information? Yes, it is. Let me explain further what exactly an outside day means. So here we have a former high. The high was 38.95 and this candle was 38.92. So we got 95 as the high. So here we got 39.01 and today's high was 39.04. So they made a nominal new high, a slight new high. That's it. That's all we need to know. But they've come down to put in what's called an outside day, meaning the high of today is higher than the high of the previous day, and the low of today, including the close, is below the low of the previous day, creating an outside day. In technical parlance, it's generally speaking a signal. It's one of many signs and or signals of a possible trend change. Where do you find the rest of them? In the course, Lazy E-mini Trader. And you knew that was coming. Let's look at this objectively. We've had a lot of one-day wonders across markets in the past, recent months, let's just say. We're above all the moving averages. So until they give up at least the 20-period moving average on a closing basis, we're not even going to worry about the outside day. Here's a weekly chart. The XLF is in a trend, meaning an uptrend from bottom left to upper right. One day the market was down today on the daily chart. We're not going to make a federal case out of that until we have to. Smash Mouth, here's what we know about Smash Mouth. Came into this spot on time. Now, all of a sudden, next scene shows we're at new highs. And guess what? Again, on time with some other stuff going on. Wouldn't say it's exactly a full stack, but we've got a short stack going. The SMH is a good proxy for the tech space. They made a new high. So if they pull back a little bit off of a new high, that's garden variety market behavior. Making a new high and pulling back a little bit doesn't mean the market's bearish. Making a new high and pulling back a little bit means that it made a new high and pulled back a little bit. That's it. You don't need to read any more into it than that until something materially changes on the chart. Then we read something into it. But until that happens, you don't have to. Just take it at face value. We're the umpire calling balls and strikes. What we don't want to do is make up situations that we would like to be true. Have I told you how much I appreciate each and every one of you? Without you, these videos are not possible. That is true and accurate information. We're going to pull the ripcord here today. I'm David Frost. My strategic forecast. Thanks again for tuning in to another episode of Common Sense Market Analysis.